Welcome to our comprehensive guide on index funds, one of the most popular passive investing strategies available today. Index funds have revolutionized the way ordinary investors can participate in the stock market by providing a simple, low-cost method to build wealth over time. These investment vehicles allow anyone to track the performance of major market indexes without requiring extensive financial knowledge or constant portfolio management. Today, you'll discover why index funds have become the cornerstone of many successful long-term investment portfolios, and how they can help you achieve your financial goals through disciplined, passive investing. An index fund is a type of mutual fund or exchange-traded fund designed to track the performance of a specific market index, such as the S&P 500. Think of it as a basket that holds all the same stocks found in a particular index, in the same proportions. For example, if Apple makes up 7% of the S&P 500 index, then an S&P 500 index fund will allocate exactly 7% of its money to Apple stock. This approach provides investors with broad market exposure while requiring minimal active management. The fund's primary goal is not to beat the market, but rather to match its performance as closely as possible, making it an ideal choice for investors seeking steady, long-term growth. Index funds offer 4 compelling advantages that make them attractive to investors of all experience levels. First, they feature remarkably low costs, with expense ratios typically ranging from just 0.03% to 0.20% annually. This means more of your money stays invested and continues growing. Second, they provide instant diversification by holding hundreds or even thousands of individual securities within a single fund. Third, they're incredibly time-efficient, requiring no constant monitoring, research, or decision-making about individual stock picks. Finally, they deliver consistent returns that closely match overall market performance, which historically has rewarded patient, long-term investors with solid growth over decades. Index funds come in 3 main categories, each serving different investment objectives. Stock market index funds are the most common, tracking indexes like the S&P 500, total stock market, or NASDAQ. These funds give you ownership in hundreds of companies across various sectors and sizes. Bond market index funds focus on fixed-income securities, including government bonds, corporate bonds, and treasury bills, providing more stable returns and income generation. International index funds offer exposure to developed markets, emerging markets, and global diversification beyond domestic investments. By combining different types of index funds, investors can create a well-balanced portfolio that matches their risk tolerance and investment timeline. The difference between index funds and actively managed funds becomes clear when examining costs and objectives. Index funds typically charge expense ratios between 0.03% and 0.20%, while actively managed funds often charge between 0.50% and 2.00% annually. This cost difference might seem small, but it compounds significantly over time. Index funds aim to track market performance, accepting whatever returns the market delivers. In contrast, active funds attempt to beat the market through professional fund managers who research, buy, and sell stocks based on their analysis. However, studies consistently show that the vast majority of active funds fail to outperform their benchmark indexes over long periods, making index funds the more reliable choice for most investors. Understanding how index funds operate is surprisingly straightforward. The fund uses a simple mathematical principle. Fund holdings equal index composition multiplied by fund size. When you invest money in an S&P 500 index fund, your dollars are pooled with thousands of other investors' money. The fund manager then uses this collective money to purchase stocks in the exact same proportions as they appear in the S&P 500 index. If Apple represents 7% of the index, the fund allocates 7% of all invested money to Apple shares. This replication process happens automatically and continuously, ensuring the fund's performance closely mirrors the underlying index, minus the small annual expense fee. Successful index fund investing relies on three proven long-term strategies. Dollar cost averaging involves investing a fixed amount regularly, regardless of market conditions. This approach reduces the impact of market volatility by purchasing more shares when prices are low and fewer shares when prices are high. The buy and hold strategy means purchasing index funds and holding them for decades, allowing compound growth to work its magic over time. Portfolio rebalancing involves maintaining your target allocation across different index funds, perhaps 60% stocks and 40% bonds, by periodically adjusting your holdings. These strategies work because they remove emotion from investing decisions and harness the market's long-term upward trend. Index funds represent the ideal investment choice for several compelling reasons. They're perfect for beginner investors and busy professionals who want market exposure without the complexity of stock picking or active management. Historical data shows that index funds outperform approximately 85% of actively managed funds over 15-year periods, making them a statistically superior choice. They serve as an ideal foundation for retirement portfolios and long-term wealth building because of their low costs, broad diversification, and consistent performance. Most importantly, index funds reduce investment risk through instant diversification across hundreds or thousands of securities, protecting you from the failure of any single company while still allowing you to participate in overall market growth.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.